Good evening, everyone, and welcome back to the Master of Money. I'm Steve Beeman, your host, and I want to personally thank you for joining us tonight. Whether you're here live with our Masters of Money meetup group, or you're joining us through the Ustream feeds that come through safefinancial.net, we're pleased that you spend this evening with us, and we hope that the information we provide can help propel you down a better path to prosperity. Now, tonight's program is going to talk about something that I've spoken about many times. It's how to select the right investment advisor. It's a very complicated world out there, and I find that many people, including some of the most seasoned corporate executives, really don't have a clue about how to manage their own money. Well, I'm reminded of the analogy of a lawyer who would be taught first out of law school, never defend yourself. Well, people should be like that as well. Whether you're schooled in money or not, never manage your own money. Hire a professional to do it. They'll see it more objectively than you do. But with that said, how do you know which one to hire? How do you know which one is going to meet your very specialized needs? Well, we're going to talk about that tonight. And once again, the Master of Money program can't go as in-depth as we'd like to do. That's what we offer the questions at safefinancial.org for. So if you have questions, write us there, and we'll see if we can't help you. Again, we have the Master of Money Meetup program here in Illinois, so if you're anywhere nearby, join us through Meetup and join our Masters of Money program. We'd love to see you face to face. Again, tonight's program, we're going to continue down this path talking about selecting investment advisors. Now, last week we talked with you about 401ks, and we talked about 4 key things. We talked about how they had evolved out of defined benefit plans into defined contribution plans that put you in the driver's seat, which can be good or bad. It gave you control of your money, but it also gave you the responsibility to properly manage it. 2 different stories. We then talked about the idea that's evolved over time of the set it and forget it mindset, whether it's through what's known as a target date fund or other types of investment plans. We find many plan participants simply set their investments and forget them. And we talked about the danger of that in what is today a more volatile market perhaps than we've had. So we want to be cautionary about set it and forget it strategies, and we did specifically then dial into the target date funds and how these are set for a problem should interest rates begin to rise. And then finally we talked about the liability trap for sponsors. This is a hugely important issue, and I'll actually be writing more on this in the weeks to come. There is, because of Department of Labor regulations, new changes that have come about in the 401k space. And these new changes have targeted directly to the plan sponsors. It creates personal liability on these people if they don't offer a fiduciary level of concern for their employees. Well, that's a very specific thing, and it's hard to do. So we wanted to make sure you were aware of that. In fact, when we talk about today's question, it related directly to that. We'll get to that in just a minute. We also talked to you last week with an update on our stock picks. And again, the importance of the process we follow, not necessarily the companies themselves. And we introduced you to Phil Erlinger's volume swing indicator. We had a lot of interesting questions about that. People who day trade or want to be actively involved in trading. Well, if you're involved in that and you want to learn more about the Erlinger volume swing indicator, feel free to write me directly at steve@safefinancial.org. That's my personal email, comes right to me, and I'll see if I can't put you in touch with the folks from Superstock. So we hope that that information is helpful. Now, going back to the question we had, and this was a highly important one. A business owner wrote me through questions@safefinancial.org and said, I saw your program. I'm very concerned that I'm in the position of being in that liability trap. How can I be sure? Well, we talked about their investment policy committee and their investment policy statements, and we talked about the possibilities they had to improve their fiduciary positioning. Well, after a lot of discussions and a lot of work, I think we put him on a path to new prosperity by introducing him to a SAFE certified advisor. Now, you may remember that program. The Society does endeavor to find advisors with whom we would trust our own money and then refer them to you when it's appropriate. These are people who are fiduciary or hit fiduciary standards that are relevant and are licensed in the appropriate way to give you the kind of service we think is so important. So we were very pleased to be able to help that individual. And he and I talked about, again, those basic things. We talked about how sponsors, providers, and employees have changed under these new fiduciary laws. We talked about the gap that exists in advice between the sponsor and the participant. And then finally, we talked about the 338 fiduciaries. I spoke with you about that last week. And then the Safe Certified program. So as you have questions, please keep them coming at questions@safefinancial.org. We're very pleased to take them, whether it's about your personal financial circumstance, someone you know, or a business you run. Questions@safefinancial.org gets you right to us. Now, in the week in review, as I write this, I was so pleased because in the geopolitical space, for the first time in, 6 weeks, I wasn't going to mention Russia. Well, I'm sorry to say that blew up. Mr. Putin in Moscow seems to like to rattle the sabers quite a bit, and just last week he started coming out once again with the nationalistic talk about the Russia versus the West. And he talked about how you can't keep the bear down, and really started to raise the stakes in what is becoming another Cold War. Well, we're watching him very carefully to make sure that it's all just rhetoric and not legitimate action. But he does seem to like to fly his bombers into our airspace. We hope that that's about all it is a tease to test the American Defense Forces. So he does come up again. They're scared. They've got $56, $60 oil prices. I think Monday it closed at around 60 because of problems in Libya. But they're scared because with the sanctions we put on them and those low oil prices, Russia is having a very, very hard time of it. In fact, I just saw today that in some of the major malls and things like that, they're using American flags as mats to wipe their feet on. So I think they're not real happy with us, and that all has to do with the sanctions that you and I've spoken about because of the Ukrainian situation. But the three big ones I wanted to talk about this week. Number one, I wanted to go to North Korea. All of you heard about the movie that came out called The Interview. And I'm not going to quote the names of the actors as the president did. I don't remember them. But The Interview is a story about an American journalist who's sent to assassinate Kim Jong-un, the dictator in North Korea. Well, the North Koreans didn't take too kindly to this movie, and in response to it, hacked into Sony Pictures technology and computer systems. They released a bunch of emails that were an embarrassment at minimum, but it also created a first shot in the cyber warfare era. Well, following up on that last week, no one knows who did this, but lo and behold, the internet in North Korea went down. Now, there's speculation this was a U.S. response. No one really knows. But the North Koreans came out of that and flat out said, they accused the president of being what they referred to as a monkey and said they're going to bomb Washington. Now, I wouldn't be too concerned about this. The North Koreans have been threatening nuclear action just about once a year whenever they want something. Now, typically it's in the spring when they need food. So this is a little out of calendar, but they're a big threatening nothing. So we don't worry about it. But I do think it's interesting to watch as the concept of cyber warfare comes to the United States and to our companies. The second thing, though, that really is picking up steam is this fracking technology that's got oil prices down so low. We're seeing gas prices in the United States around $2 a gallon, and that's a real blessing to the American consumer. Now, in addition to U.S. fracking, which now has the U.S. being the world's largest producer of oil, it was released, and I spoke to you about this 2 weeks ago, it was recently released that the United States has only 10% of the world's fracking reserves. So there's an awful lot of oil out there, so the supply of this very necessary fuel won't be going away anytime soon. Now, we saw a little kick up in prices Monday as Libya had some instability, but net, I think most of the people in the industry expected to stay between $60 and $80 for the foreseeable future. Well, that's nice to the American consumer, and it is truly moving the U.S. toward an economic recovery. The final thing I think geopolitically of importance to you is that we began last week to normalize relations with that embattled island of Cuba. For the first time since the revolution in the 1950s, we actually took steps to take them off the terrorist watch list. Now, the reality is we aren't normalizing relations with them. We haven't opened up diplomacy, but we've taken the first step. And you can argue this for the good or the bad. I'm going to stay out of the politics of it and stick purely with the economics. And economically speaking, this could be a real boom for the American farmer. I think the last number I saw is that we could expect to ship something around 50 billion bushels of wheat into Cuba if we open up trading relations. That's a significant boom for our farmers, and so from an economic standpoint, this could be good. A lot of heavy equipment manufacturers like Caterpillar in the United States are excited to open up Cuba because that backward country needs all the help it can get. So if you take tourist dollars that bring hard currency to it and American manufacturers, we could see a little blip up in the American economy as a result of Cuba. Again, I'm staying out of the politics of it. I know there are people who feel very strongly against this given the dictatorial nature of the Cuban regime. Like them, I would like to see communism thrown into the trash heap of history, but maybe by opening this up we can show the Cuban people that freedom is superior to tyranny. Now, moving into the economic area, I thought it was interesting to quote once again or talk about Peter Schiff. I've talked to you before about perma bears and perma bulls. Well, Peter Schiff and others are perma bears, constantly saying the sky is falling. And Mr. Schiff was out last week speaking the same thing, claiming that the Fed is going to lose control of currencies and our dollar. That's an argument that's been going on for 3 years. Mr. Schiff called for the destruction of the U.S. stock market. Well, let me caution you. If you're invested right now, it is a bit of a nervous time. The markets have hit all-time highs, we're on a great run, and no bull runs forever. But don't take the emotion of the moment and sell your positions because the perma bears come out and scare you. Use logic, use facts, and use the numbers. If you're in the markets, put some downside protection in it, but don't necessarily get out wholesale because you've become scared by Peter Schiff or any of the other perma bulls or perma bears, excuse me. Secondly, as we look at the continuing economic data coming in, virtually all of the data now is positive. We've got good employment numbers, good manufacturing growth numbers, good real estate numbers, good auto sales numbers. We really are seeing a bit of a recovery here. Now, you and I both know that the employment numbers are a little bit misleading. Many of the jobs created in the last year have been part-time or substandard wages. Well, with that said, it's nice to see the fundamental numbers coming through a little more positively. This is a bit of a nice thing given the fact you've still got Europe as a basket case and China slowing down. The U.S. is carrying the rest of the world. We hope that continues here in the fourth quarter. We're keeping a very close eye on retail sales as we come through. I know we had a very strong Christmas time, but then right after Christmas, we had record returns. We're not sure what that really means right now, but we're keeping an eye on it to make sure the sales numbers hold up. Finally, in the economic area, Great Britain squeezed by France to become the world's 5th largest economy. Now, Great Britain should get kudos for that. They've come through a really hard time the last many years, from their experiment in socialism in the 70s to the resurgence under Maggie Thatcher. But the reality is, the funny thing about Great Britain's economic growth, a lot of it's been driven off of, I almost hate to say it, sex and drugs. Yeah, Britain is growing because of those illicit parts of the economy. They supersede France, which, well, they're probably involved in it too. But anyway, we salute Great Britain for rising a notch. I'm not so sure we salute them for how they got there. Now, moving into the financial markets, it was a good week for the markets with continuing their record-breaking run. The S&P, the Dow, and the NASDAQ all rose by over 1%. And the VIX continued its slide, that volatility indicator that we look to. It dropped about 15% last week, coming off of that 20-something% gain the week before. Well, volatility is something that's inherent in the markets. We like to see a little bit of it because that makes the traders money. But net, I'd like to see that nice bull keep running along. We'll see if it does. Now, tonight, as I said, I'm going to talk to you about something that I've spoken about many times, dozens of times, because I think it's so important. In the 25-year career I've had, I've seen countless times when very senior people even sold a business, retired from a business, but had no clue what to do with the money they got. So who do they get advice from? Well, maybe their accountant, maybe the stockbroker they've known for 20 years, maybe the banker they've known. But do they really understand the different motivations of these people? Well, tonight, we want to continue our path to prosperity, talking about how you select these advisors, how they're licensed and what those different licenses can tell you, how they're compensated, and then talk about their styles and their methods of managing money, all of which is information you can use to determine who the best advisor for you would be. So we think it's critically important, and we welcome you to stick around for that. We're going to be right back. We do like to show our robo-advisor program because we think that's important too. I've talked about it before, but so often people get wrapped into these robo-advisors. There's no personal attention and no understanding of who you are. Well, part of managing your money is understanding you. And the robo-advisors can't do that. So we like to throw a little bit of slam at them during this program. So anyway, we're going to watch that little blip, and then we'll be right back on the other side, continuing with how to select an investment advisor. We'll be right back.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program. Once again, I'm so pleased that you're with us tonight. This is a cool program. We're excited to talk about it because, again, in the 25 years I've spent on Wall Street, this is one of the most misunderstood areas of finance I think I've ever come across. So we're excited to talk about how to select an advisor. You know, it was once said, and I mentioned earlier, it's relatively easy on a comparative scale to earn money. It's much more difficult to keep it. And who you select as your advisors oftentimes makes that difference. And I do want to go back, just as lawyers have the rule, never defend yourself. Well, I find it very rare that people, no matter how schooled they are, should manage their own money. We're too close to it. We're too emotionally tied to it. And as a result, we have fear, uncertainty, greed. All of those emotions that we caution against come into play very closely when we manage our own money. So we would absolutely recommend to you very strongly that regardless of your background, when you get a pot of money, hire a professional advisor to look after it. I think you'll be well served. Now tonight we do want to talk about how to discriminate between the good and the bad advisors. I mean, is it just a feeling that you have? Do you just feel good about somebody? Or are there really qualitative things you can look at to determine who fits your specific needs? Well, as I've been in this business, I've seen both sides. I've seen people get snookered by brokers who are out to transact commissions, and I've seen people who have advisors who, well, their interests aren't aligned with theirs. So we're going to talk about this very much tonight, and let's begin by recognizing that advisors come in all shapes and sizes and everything else. In fact, there are probably as many advisors as there are stocks on, in the Wilshire 5000, and different styles too. We know that each of these have three components we're going to look at tonight. We're going to look at how they charge you. Some of them charge you a transaction fee, so you don't pay unless they transact in your account. Some of them charge you a % of assets. Some of them charge you a performance fee, and some a blending of them. Well, we want to look in detail at which of those fee structures can serve you and when each of them is appropriate, because each has its place. None of them are all bad, but we want to make sure that you use the fee structure that's right for you. Secondly, or then third, we're going to look at the styles of the manager. So if you look at the structure of the manager, the fee structure of the manager, and third, the style of the manager, we want to look at whether they're value players, growth players, momentum players, what their style is, and then what their process is. If you're going to trust your money to someone, shouldn't they have a process they can describe for you? Just today I was in a meeting, and one of the folks was talking about an advisor they knew who just yesterday said, "I'm getting out of this market." Why? I don't know. I just don't feel right about it. Well, you know what? I've very rarely in my life met people who feel their way to success. The fact of the matter is it's a thoughtful process based on a process that's been tried and tested. So we want to look into advisors on that level as well. So we want to look at their credentials, kind of who they are, how they operate, their fee structure, and their styles tonight. Now there's more. We could talk for a lot longer on this topic, but we're going to cover those three, and then if we move forward in another program, we'll take questions and go from there. But let's recognize again that all advisors come in all different types of shapes and sizes. There's all kinds, from brokers to insurance agents to CPAs to attorneys to financial planners to investment advisors. Now I did want to mention, I have a little note here, that a special note. I do hold what's called a Series 65 license. That certifies me to be a financial advisor representative. Now I tell you that because it shows you a little bias I may have. I am not licensed to be a broker. I'm not licensed to be an insurance agent. I'm licensed to represent financial advisory. So I do have a bit of a bias, and I wanted to make you sure you understood that. But let me talk as I bring up the licenses. When you talk to your advisor or the people you're considering, you should understand that there are very distinct licenses produced by the federal government that give people the right to work within the industry. There are series up. Series 3, which gives you the right to trade commodities. Series 6 gives you the right to sell mutual funds. Series 7 makes you a registered representative of a brokerage firm. There's a Series 66, Series 65. There are all types of these series licenses. When you're talking to your investment advisor, get a handle on what type of license they hold. It's very, very relevant. If you're talking to someone with a Series 7 license, and let's say not a Series 66, now that is just jargon to you, but what it means is they're licensed to be a broker but not an advisor representative. Well, they're going to have an incentive to charge you a certain way. They're going to want to sell you certain products. Whereas someone that just holds a 65 is going to try to move you in another direction. Another person might hold a Series 6 and just sell mutual funds. Well, they're not out to sell ETFs or stocks. They're out to sell you mutual funds. These are very simple determinations you can make by just looking at the licenses held by the people you're talking to. Now, secondly, if you follow that license path down, you get into how people are compensated. Now, when I was a broker, and this is many, many years ago, but I had a Series 7 license. I had a 3, 6, 7, 63, and all these licenses. Basically what it meant is I could sell you a stock or buy a stock from you and trade it to someone else. Well, what do you think that set up as my motivation? To transact, to set up trades. Now, I also held a Series 6, which let me sell mutual funds, and I'll tell you a quick story. This is just between you and me. Don't share this story with anybody. I had a client And he had just retired with his wife from a company with $1 million out of their pension plan. Now, going back 25 years, that's a lot of money. I met with them, and this is back when interest rates were at, 15% for a 10-year bond. Well, as we talked, I realized that first, they were in their late 60s, early 70s. They just needed income to last out the many years they had left. They didn't want to risk the principal at all. They just needed income. So I sold them a series of certificates of deposit. These had very interesting characteristics. They were safe. They were all guaranteed by banks. They had very high interest rate. And third, they had no commission charge. Well, the next day when I went into my branch office and submitted the tickets for $1 million of CDs, you could hear the explosion out of the manager's office because I had sacrificed, instead of putting them into a mutual fund, which at that time might have had an 8% sales charge or an $80,000 commission, I sold these people CDs, which had no commission. Now, I obviously saw the world a little differently than the branch. That's one of the reasons I wasn't a great retail broker, frankly. But the fact of the matter is, as a broker, commissions were king. There's no question about that. And it's important to note, if you're looking at a Series 7 licensed individual, you want to ask them how their fees are structured. Are they commission driven? Well, if they are, you and I both know they've got an inherent incentive to move you around. The second type of fee structure that you'll run into are asset-based fees. A typical advisor will charge around 1% of assets to manage your money. Now, some of these advisors also provide comprehensive financial planning. Now, we think that's important at the society because putting together a comprehensive plan for you is the only way you're going to account for everything you've got and put it in the framework of a plan. 1% is certainly not an egregious fee. So if you have $1 million, you're going to pay a whopping $10,000 a year to that advisor. It's not egregious by any stretch, but it gives you an alignment of interest. If your funds grow, their fee grows. So as a percent of your assets, you have a real participatory feeling between the advisor and you. Now, most of those advisors will have a blend. Some of the products they sell, for example, in doing a comprehensive plan, it might be appropriate for you to buy an annuity. It might be appropriate for you to buy life insurance. Those types of products don't lend themselves to the asset-based fees, so they're typically charged a commission. It's not bad, it's just the way they're sold. So many advisors will have both a commission base and an advisory fee base, but you want to understand where their core revenues come from. Are they transaction-oriented or are they advisory-oriented? The third thing I want to talk about are hidden fees. Often, when you buy into mutual funds, you should be aware, and if you have a 401k, you really should watch this. Mutual funds are notorious for having hidden fees. There's something called a 12B1 fee that effectively allows the mutual fund to put its marketing cost into a backload on a fund that you buy. So you may not pay a front load, you may buy into a fund and it's no charge to get in, but when you sell it, they take a backload off of it. That's a Series 6 license that allows someone to sell mutual funds, so be aware of that. Again, this is part of the core knowledge you need to have to be a true master of money. So as we kind of migrate through transaction-based to fee-based to combinations up into the hidden fees, the last one I want to talk about are performance fees. Under most securities laws, it is illegal for an advisor to participate in performance along with you. So if you say to your advisor who's a good buddy, hey, if I'm up 10%, I'll give you part of the profit, you can't do it. It's illegal. But there are private partnerships that allow you to pay performance fee to the advisor. These are typically thought of as hedge funds. A typical fee for a hedge fund is 1% of the assets plus 20% of the profits. Now, it's interesting as I watch these things. The hedge fund world grew up because they did very sophisticated strategies that weren't often available to investors outside of a performance fee base. Well, today, I know advisors who have strategies every bit as successful as the hedge funds, but just charge the 1%. They don't charge the performance fee. So don't think just because you're paying a performance fee, you've got a more sophisticated process. You may not. So as you look at two things we've covered, talk to your advisor about the licenses they hold, 3, 6, 7, 24, which is a principal, 63, 65, 66. Ask them what they're licensed to do. Then, what's their fee structure? Transaction-based, fee-based, performance-based? What's their structure? And then finally, let's spend some time talking about their structure of investing. There are some core things you need to understand about how people manage money. First, philosophically, most of us and most advisors fall into one of 3 or 4 camps of how they look at investing. They're either value investors, meaning they look for companies that are good, solid companies but out of favor. They look for growth companies, companies that earnings are growing very rapidly for future growth. Momentum, meaning that the short-term movement of earnings and sales and prices are good. Or technical, meaning that the price behavior of the stock is one that makes that stock look likely to go up. Those are 4 kind of core thoughts in terms of style. Each of them is valid, but you need to make sure the style fits with your philosophy of investing. If you sit down with an investor, and let's say you're 66 years old, you've just retired, you took $500,000 out of your 401k and you're sitting on that pot of money, you're interviewing advisors, and you talk to a guy who is a growth-oriented manager. He's going to buy the Disneys of the world early on, the Apples of the world early on, but before you knew about them, keep in mind, so you didn't know they were going to skyrocket. That may not be what you feel comfortable with. You may want to play more like a Warren Buffett that says, I want to buy things really cheap that probably will expand their multiple or grow in their multiple expansion. Those are core things. They're philosophical, but you need to know it. And as you interview your advisors, you've got to know where they stand. The second thing to know is how they achieve their results. Do they invest in mutual funds? Which I'm going to talk about mutual funds and a trap that's set there in just a minute. But do they buy ETFs? Do they buy stocks? Do they do private placements? Do they use insurance? Are they a total comprehensive financial planning firm? These are all highly relevant pieces of information you need to go out and select your advisor. Now, if you're in a position where you really don't know where to go, send us a note at questions@safefinancial.net or .org. And what we'll do is try to put you in touch with one of our SAFE certified advisor. These are people who have the appropriate licenses, the appropriate fiduciary designations, the appropriate styles and structures of investment that we feel very comfortable with them. So feel free to write me about that if you're not sure where to go. Now, there is very much more to learn about that. I could do entire programs on styles of investing, which we probably will. But the bottom line is this. If you're in a situation where you're looking for an investment advisor and you're talking to lawyers, accountants, brokers, insurance people, bankers, keep those things in mind. How are they licensed? How do they charge? And what's their style? Now, one final note I will tell you, you should also be able to get a defined process from these people. I mentioned earlier the guy that I talked to just today or yesterday who said, I'm getting out of the market because I don't feel good about it. If an advisor you're talking to operates off feelings, I would suggest you run away. They need to have a process they can define for you and tell you about. It's process and discipline that make money in the markets. Coming out of a 20-year background in quantitative research, I can tell you that following discipline is what makes people money. So if you got an advisor on that other camp, run away. Now again, I know we can't always do things for you in comprehensive nature in the Master Money, but keep with us. Next week we're going to have another path. But as we go, remember to write us at questions@safefinancial.org. It's very important. We are there for you. We exist to support the retail consumer. So write us at questions@safefinancial.org. Now, last week we did talk, as I said, about Superstock. And as it's a Christmas week, we hope everyone had a nice Christmas and you've got a nice and safe New Year's plan. We're not going to talk about stocks so much tonight from Superstock, but I had a long conversation with Jeff Garbaz today, the principal at Superstock. And Jeff and I were talking about an article in the Wall Street Journal over the weekend by Jason Zweig about mutual funds. And I found it interesting because you and I have talked about mutual funds before, and I've talked to you about the tax trap that can evolve. Well, we were talking about it. I have notes somewhere around here on the problem this year that's evolved is most mutual funds haven't had a really good year. The broad markets were only up about 8%. What's happened is they're taking gains to make themselves look better, but they're short-term gains and they're cramming them into this year. So even if you didn't experience the gain, you're still going to get a tax bill for it. That's a natural inefficiency to mutual fund accounting. It's one of the many reasons we talked to you about using ETFs instead of mutual funds. Now, I did also want to mention, if you follow those stocks we've talked about, Cisco on down the line, Ford Motor, they've all continued to do well. Now, a lot of that's because the market's been doing well in addition, so we're always happy about that. But keep in mind the process. We're looking for companies fundamentally sound, good management, good product, good valuation, good growth, and that final technical blip, maybe a volume swing indicator. So that's our program for tonight. We hope you've enjoyed it and learned something about how to select an advisor. I hope you have a great New Year's Day coming up, and we're looking forward next week to beginning a new year for the Master of Money. It'll be our first full year. We've now put about 14 of these episodes under our belt, and we look forward to 52 more next year. So we want to thank all of our sponsors, Harvest Investment Services, who does provide me with a great deal of content. And again, I'd love to feed that content to you. If you write me at steve@safefinancial.org, I'll make sure you get access to the Harvest newsletter. We would welcome you as well to visit our new website at safefinancial.org. We've restructured it, and I want to thank Mike Atwood, who's been so instrumental in helping us with that. But we've made it a little more user-friendly, a little bit easier for us to manage, and we hope you'll visit it and give us your thoughts on how that looks. There is a sign-up right there where you can sign up for the Society's membership. No charge to you, but it lets us communicate with you. We'd love to have you sign up, so visit safefinancial.org. I do want to thank Ron Blake for the music he provides, and Chris Janssen. I want to thank you most of all for spending your time with us. So we look forward to seeing you next week, and please join us as we once again present the Master of Money.